Hello, this is Will Allen with Centera Capital. Well, we are now in March, which means it's March Madness, which is great because it's my favorite month of the year, being a college basketball junkie. Next week, we have Evan Temple back. He is a client of ours. He's also our creative director, but he's back. He joined us last August and asked questions from a client's perspective about the financial markets. We got great feedback on that, so we're going to have him back next week. Stay on the lookout for that. Today, we're talking about fourth quarter earnings from companies, and we're also talking about the state of consumer. Let's get into it. Okay, before we get into the market update, just a reminder to like and subscribe or share this video. We appreciate it. We know that most people out there don't get market updates from their advisor, so this gets the word out that they can get this kind of information from us. We appreciate it. All right, so we're going to talk today about a couple key topics, and the first one is we now have most of companies have reported their fourth quarter earnings, meaning that what were their revenues, what were their profits, and many of those companies give outlooks as well. That's very, very critical. But what we can tell you is that with almost all the companies in the S&P 500 reporting so far, earnings growth has come in at over 8% year over year. That is a really strong number. Just to give you an idea, just 3 months ago, earnings were expected to come in at about 2 to 3% year over year. Now, we're going to put up a chart that shows the breakdown over different industries in the market. We're going to put that up. What you'll notice here in the top right under S&P 500, the blend of actuals and estimates, 8.4%. And if you go down that column, you can see that there are a couple of industries that have had a decline in earnings. Basic materials, energy, and then healthcare is on there. Energy is a positive that has declined because oil prices have gone down. So that is a good thing on the negative side. Now on the positive side, what will jump out here is technology up 24%. And consumer discretionary up 31%. These are two of the most important categories. Obviously, we know tech is the biggest part of the S&P 500 at over 30% of the makeup. And then consumer discretionary, these are companies that largely are where the consumer goes and spends money on experiences. So those are the two we watch the closest. It is great to see that their numbers have grown a lot. Now, on the topic of technology, we want to mention something. If you were to go back last year at this time and look at what were earnings expectations for basically what's known as the Magnificent 7 plus 1. And what we're talking about there is, this calls it the Elite 8 stocks. It adds Netflix to the Magnificent 7. These are Apple and Microsoft and Google, Nvidia, companies like that. They have had their earnings grow significantly. So we're going to put up a chart here that illustrates this point. This is looking at what are expectations of analysts of what these companies' profits are going to be over the next year. And you can see that last year at this time, which is the dotted line, between then and now, you'll notice that the blue line is the 492 stocks that aren't these big tech names. And you can see that earnings expectations is up about 10% from last year to right now over the next 12 months. But the tech names, look at how they have gone almost straight up, almost doubling expectations of what their profits are going to be versus what was expected last year at this time. That is really a very impressive number, and that's one of the reasons that the stock market has done so well. these big tech names, their profits have exploded higher. These are great business models. And it's one of the reasons, by the way, for years that we have had technology as our biggest weighting in client portfolios, because we know that the growth there, you can't get anywhere else. You can't get that in international stocks, and you can't get that in small caps and much of the rest of the S&P 500. So that's something that is really hits home why these tech names have done so well. Now, let's get back to the S&P 500 for a second and talk about total earnings of companies in the S&P 500, which includes the big tech names we were talking about there. I'm going to put up a chart that shows earnings per share in the S&P 500 by calendar year going back to 2014. What you need to know, and we'll put that chart up, if you look for calendar year 2014, earnings came in at $119 a share. That has grown over the years, and if you look at calendar year 2024, expectations this year are for $243 in earnings for companies in the S&P 500, meaning that earnings profits have doubled going back to 2014. If you want to know the reason that the stock market has done very well over time and is a great place to invest in, this is the reason, because earning growth has been very strong on the back of strong performance for U.S. companies, with many of the tech companies being the primary driver there. But that's one of the good things we wanted to tell you is earnings are back, they're growing, and they have been the main reason why the stock market has gone up so much in the last couple months. Our last topic for today is looking at the state of the U.S. consumer, and just as a heads up, this is a topic we'll be broaching with Evan next week in more detail, so be on the lookout for that. There has been a chart making its way around the financial media in the last month or so looking at total amount of credit card debt in the United States, showing that credit card debt is at an all-time high. And we'll put the chart up. You can see going back to the year 2000, credit card debt has been going up most of the time. There was an exception following the financial crisis when there was a lot of bankruptcies and whatnot. And then also credit card debt went down early in the COVID days because people paid down a lot of the credit card debt with a lot of the stimulus money or savings because they weren't doing very much. But you will notice over the last couple of years, the credit card debt has gone up and is now at an all-time high of $1.12 trillion. But there's some context needed here, and that is you also have to consider what is happening on the income side of the ledger. Can consumers handle the credit card debt? So let's put up a chart looking at disposable income in the United States over that same time period. And disposable income is basically income available after paying taxes. Okay, that's what we're talking about here. So if we put that chart up, you can see that that has gone up pretty consistently since the year 2000 and is at $20.6 trillion right now for the U.S. consumer. So the important graph that we want to look at brings those two together in one chart. And thanks to Carson Research Group, which is an independent shop that we like a lot, we like their data, this is a chart that they have. So we're going to put it up there. This says credit card debt as a percentage of disposable income. So the income that you're bringing in and then you're using to pay your credit cards with, that's what we're looking at. And notice that this goes back again to the early 2000s. And in those early 2000s, this was up around 8%. That was a high number that where people were in a situation where they had a lot of credit card debt, interest rates went up, and they could not afford the payments. Notice then after that point that that number declined for many years. Then when COVID happened in 2020, this thing dropped like a rock down to about 3.5%, which was basically an all-time low. Now, in the last couple of years, this percentage has gone up. If you take a look at it, you can see it's gone from 3.5% up until 5.5%. That's kind of back in the range it was at pre-COVID, and it's below its pre-pandemic average of 6.4%. Meaning that consumers' incomes have gone up enough that they are still able to pay their credit card bills without too much stress to the bottom line. Now, we're watching this closely. If this thing continues to rise and gets to 6.5%, 7%, that's going to start to be an issue, especially if consumers start to lose their jobs, if layoffs go up. So we're watching this number closely. We're watching the jobs data very closely, as you know if you've been watching our videos over the years. But as things stand now, it's okay. The chart showing that credit card debt is at an all-time high and scaring people that means the end is near. That is not the case when you take a look at the other side of the ledger. Well, that's going to wrap it up for today. Thank you so much for watching our video. Don't forget again to like and subscribe, and don't forget to be on the lookout for our video next week with Evan Temple. Take care. Hey folks, thank you so much for watching the video. I want to mention that we just brought on a new client at Cetera Capital who said they had not had a portfolio review from their advisor in 2.5 years, and that they had not gotten a market update like our videos do ever. If that is you, go to CeteraCapital.com. You can go to contact and reach out to us. We also put our phone number in front there. You can call our office and get an appointment with a real person, and we can talk about the process we go through at bringing clients on board, and it will solve the problem if you don't hear from your advisors and if you're not getting market updates. Thank you so much. Take care.